So the first of the 5 disciplines is awareness. So as we move through these things, we need to look at awareness and say, hey, let's understand your needs. Because without understanding your needs, it's really hard to do anything, both from an advice perspective or if you're doing this yourself. Now, understanding your needs is really hard when you're the person with the needs, because quite often you don't know what you don't know, and you don't admit to a lot of things yourself. You let yourself off the hook. So the first thing that we do when we work with a business is we understand your needs. And that's simply done via both our scorecard initially, and then we have a more in-depth study of your needs, if you like, which is called prioritise, and we move into that once we actually are working with you and we're actually in this awareness stage. The prioritise is part of a paid service. Scorecard is free for you to do, and I'll show you the scorecard a little bit later on. It'd be a really good thing for you to do after this webinar. We also do a business valuation discovery. Now, business valuation is critical because if you don't know what your business is worth, then you're denying yourself of understanding what your true wealth is. Because your business is typically your second most valuable asset that you have other than your house. Unless you've got a property portfolio or a big investment portfolio. Now, your business is just part of that investment portfolio as far as I'm concerned. Because if you own a share in a company, then you own just that small ownership portion, a very small portion if it's a publicly listed share. With your business, you typically own 100% of it, or you own a share of it with others, whether it be a spouse or a third party. Now, business valuation discovery allows you to know what your business is worth now, because the aim of the game in business is to get to that time to go section with your business at its maximum value. Then you can cash in your chips and go to your next step, whether that be retirement or whether it be to move on to another business. But there's no point moving on to that next step when your business either isn't cooked or you haven't put in the effort to maximise its value. You're giving away money. So doesn't it make sense to know what your business is worth now so as you can then improve it for then? Most people don't start this exercise until it's way too late. They don't actually work on any of this stuff until they've decided to already leave the business. I used to do business sales and business broking, and it was really, really sad to see when somebody came in and they were so desperate to sell the business because they had to pay debts, or they had, one of them was ill and they just had to move on. So no thought had been given to growing the value of the business. Really sad, but easily dealt with. Now, the business valuation isn't a formal valuation that you would see in a court of law. It's not a forensic valuation. The business valuation that we do is what I like to call the back of a beer coaster valuation. You're looking at two things. You're looking at profitability and you're looking at risk. Now, we could talk for a whole session about how a business is valued, but essentially it's those two factors. The higher the profits, the more the business is worth. The lower the risk of the business, the more the business is worth. So the risk is how you get the multiple. You might have heard people say, oh yeah, it's a multiple of profit. Now, yes, you can value a business on a multiple of profit. There's rules of thumb that say, okay, so much of the income plus plant and equipment, etc., etc. But at the end of the day, you're going to take these figures to, or the future buyer is going to take these figures to an accountant. They're going to apply a multiple approach. Multiple comes from risk. Now, I'll explain that in numbers really simply. Let's say you have a multiple of 1. That's 1 year's worth of profit. Or 1 times annual profit. If you have a multiple of 5, that's 5 times annual profits. So obviously a multiple of 5 is a better thing because it values the business at a higher value. Now, how do you get from 1 to 5? 1 is a risky business. 5 is a low risk business. So the less risky you can make your business, the higher the multiple, the more it's worth. How do you make your business less risky? Things like systems and procedures, making the business actually be attractive to a future owner, not a scary beast that they just can't see themselves running. Making sure that you're in an industry that isn't going down as opposed to on an uphill ride. If it is going down, then what are the mitigating factors that make your business worth buying as opposed to the one next to you? So think hospitality at the moment during COVID. Okay? Who would want to buy or pay a premium for a cafe that is possibly, subject to future stay-at-home orders? Now, you might have a cafe that has a very, very good niche in catering, in takeaway, and really hasn't felt too many bumps when it comes to COVID. Sure, turnover's down, but we can get around that. So it's spread itself across the board, as opposed to a cafe that was probably going broke before COVID even came along. That's probably going to be a risky concern. Do you have forward contracts with suppliers, or is everything just open to new client every time they deal with you? So all of these factors affect risk. Profitability, what can be done with profitability? There's a whole range of stuff we can do through improvement. Improving your profit margins, looking at your cost structure, looking at driving sales and increasing the sales volume that you're doing, and looking at your pricing structure. So there's a whole heap of things that can be done on the profitability side, not just the risk. So we do a business valuation discovery to help you understand what your business is worth, and then we go about improving that to fit in with your wealth strategy. The third thing there on the screen is hidden profits. So one of the things we do when we first start working with a business owner is look for some easy wins, some of the hidden profits. And we have a calculator which works on 1%ers. And what I mean by 1%ers is what would happen if we could increase the number of customers you had by 1%. Now, it doesn't just have to be 1%, but I like to show people the effect that 1% can have. What would happen if the amount of times that they bought off you increased by 1%? What would happen if the amount that you sold to them increased by 1%? Not only through pricing, but also by strategies around on-sells and add-ons to your product, additional services that you could provide that you're currently not. So looking at all of these things within a hidden profits analysis can spit out some really easy wins that we can do, because 1% is not a lot. If we're dealing with 100,000, we're talking about a $1,000 increase. If we're talking about 500,000, it's a $5,000 increase. Now, depending on your average sale, if your average sale is $100, then that's 50 extra sales. Could you get one extra sale a week and drive an extra $5,000 into your pocket? Would that not make it worth just working on the hidden profits analysis alone? So think about your business in a broader perspective. There's so much noise out there now with Google and YouTube videos on this, and somebody else has got another video. I've got a ton of videos. But you really need the impact of somebody understanding your business intimately, not just a video from somebody who knows nothing about your business, and you take on their ideas and apply them blindly without any interpretation or context. That's the world that we live in. So as we move beyond awareness, I wanted to share a little bit of a case study. So John and Georgie owned a retail safety business, and husband and wife had a couple of employees, and despite us urging over many years as to how to go about things, husband, John, he measured the business in his trusty little notebook, and Georgie, the wife, weaved her way around all of the complex supplier arrangements, the order processes, materials needed, etc. Now, this business worked, but it worked for the owners. They knew how it ran. They understood all the little intricacies of things. But when it came time to sell, the problem was it was really evident that it needed to work for others. So we had buyers looking at this thing in the first attempt to sale where they just got cold feet. They looked at it for about 6 months, and then when it got to contract stage, they just couldn't see themselves running this business. They couldn't see they could get past the complexity of the day-to-day. So what we did was we did a process of some constant improvement over about 18 months to 2 years. The owners were able to look at things like systems and procedures, stock levels, ordering processes, the pricing of their products and the profitability. And this ensured that when the next buyer came along, they could actually see themselves running the business. It was sale ready and it was valued appropriately. It was actually valued more than what it was previously because all of these things had de-risked the business somewhat and made it a more attractive proposition for the new owner to buy. John and Georgie, they're enjoying the retired life now. They've moved on. They've been the time to go-getters and they've secured the successful sale. New owners still running quite a profitable business as far as I'm aware, which is good to see because it's always good to see a person pass the baton on and the next person add their energies to it to take it further.